Is a solo 401k right for you? Maybe, but I think that's actually the wrong first question. The better question is, where does the solo 401k fit into your overall tax strategy? Because until you answer that question, you really shouldn't decide whether to open one. Maybe you've heard someone say you can contribute up to $72,000 in 2026. That sounds amazing, right? But here's what most people don't realize. A solo 401k isn't the strategy. It's simply one tool within the strategy. Today, I'll explain the difference. Hi, I'm Lisa Marie Odeja, CPA, EA, former federal government auditor, and a tax strategist. And I help real estate investors and profitable business owners legally reduce their tax bills while building long-term wealth through proactive tax planning. And over the years, I've found many business owners start by looking for the next tax strategy or retirement plan. But in my experience, that's the wrong place to start. The first step isn't choosing a retirement plan. It's building the right strategy. Because once you have the right strategy, choosing the right retirement plan becomes much clearer. Let's dive in. So, who is a solo 401k for? A solo 401k is generally designed for self-employed business owners who don't have qualifying full-time employees other than themselves and, in many cases, their spouse. Now, that includes many consultants, contractors, real estate professionals, sole proprietors, LLC owners, and S corporation owners. And one of the reasons a solo 401k can be such a powerful retirement tool is because of the way that it's designed. Think of it this way. As a business owner, you're wearing two hats. You're the employee and you're also the employer. Unlike most employees, you may be able to contribute wearing both hats, which is one of the biggest advantages of a solo 401k. So for 2026, you can generally defer up to $24,500 as the employee if you have enough eligible compensation. Then, depending on your income and your business structure, your business may also make an employer contribution. Combined, the IRS allows those employee and employer contributions to total as much as $72,000 in 2026. And if you're eligible for the catch-up contributions because of your age, you may be able to contribute even more. Now, that doesn't mean everyone gets to contribute $72,000. That simply means that's the IRS maximum. Your actual contribution depends on your compensation, your business structure, and how the employer contribution is calculated. Just because you're self-employed doesn't automatically mean it's the right retirement plan for you. Again, the right retirement plan depends on your business structure, income, employees, cash flow, and your overall tax strategy. Here's something else many business owners don't realize. If you're eligible for a catch-up contribution, your age can also affect how much you may be able to contribute. For 2026, individuals ages 50 through 59 can generally contribute an additional $8,000. Those ages 60 through 63 may qualify for an enhanced catch-up contribution of $11,250. And if you're age 64 or older, the catch-up amount generally returns to $8,000. To make this a little easier to understand, let's look at a few simple examples. Example number 1. Let's say you own an S corporation. For illustrative purposes, let's assume your compensation only supports a total contribution of $25,000. Now, because your compensation is lower, you may not be able to contribute anywhere near the regular IRS annual additions limit of $72,000. Now, let's change the facts. Example number 2. Let's assume your compensation is high enough to support the maximum employer contribution. As the employee, you contribute $24,000. As the employer, your business contributes $47,500. Let's do the math. $24,500 plus $47,500 equals your $72,000. That's the regular IRS annual additions limit for 2026. Now, let's keep everything exactly the same. The same business, the same compensation, the same retirement plan. The only thing we're going to change is your age. Example number 3. Suppose you're 55 years old. As the employee, you contribute $24,500. As the employer, your business contributes $47,500. Now, because you're eligible for the catch-up contribution, you may also contribute an additional $8,000. Now, the math becomes $24,500, $47,500 plus your $8,000. That gives you $80,000. Example number 4. Now, suppose you're 61 years old. As the employee, you contribute $24,500. As the employer, your business contributes the $47,500. And instead of the $8,000 catch-up contribution, you may qualify for the enhanced catch-up contribution of $11,250. Now the math becomes $24,500, $47,500 plus the $11,250. And that gives you $83,250. Wow. Assuming your compensation and plan otherwise supports those contributions, notice what changed. The retirement plan didn't change. Your compensation didn't change. Your business didn't change. Only your age changed. That's exactly why strategy comes before choosing the strategy plan. Retirement planning isn't just about contribution limits. It's about putting the right tools in the right order. And depending on the circumstances, that could include an employer retirement plan, an HSA if you're eligible, a Roth IRA, a solo 401k, or another strategy altogether. The sequence matters. And that's why I don't recommend retirement plans based on internet trends. I recommend them based on each client's overall tax strategy. A solo 401k can be an incredible wealth building tool, but it's not automatically the right retirement plan for every business owner. The goal is to understand whether it fits your specific business, your goals, and your overall tax strategy. Remember, tax planning isn't about chasing the latest strategy. It's about choosing the right strategy for your specific facts and circumstances. If you're a real estate investor or profitable business owner and you're not sure whether a solo 401k or another retirement plan makes the most sense for your situation, now may be a good time to review it before another tax year passes. You can schedule a consultation using the link below or scan the QR code on the screen. And during that consultation, we'll discuss your concerns, your goals, and whether we're a good fit to work together. I'll explain how my firm works, and if we both agree it makes sense to move forward, we'll discuss the next steps. If you found this video helpful, please give a thumbs up, subscribe so that you don't miss future tax videos. Leave a comment below with topics you'd like me to cover, and share the video with another business owner who may benefit. Thank you for watching, and I'll see you in the next video.